Hi, I'm Mark King, Investment Editor at Columbia Threadneedle Investments. Joining me today for a special discussion on the result of the 2016 US election and its short and medium-term impacts is Mark Burgess, Chief Investment Officer EMEA and Global Head of Equities, and Jim Cielinski, Global Head of Fixed Income. So Mark, let's talk about the result itself. We now know that Donald Trump will be sworn in January 2017. How are markets reacting to this news?
Better than might have been expected. I think the overriding sense in the markets was that Clinton was going to win, and certainly with the exit polls we saw last night and the polls more generally, the markets were rallying strongly because they thought that Clinton would win. Clearly we've not had that, and not only have we not had that, we've had a pretty resounding success for the Republicans more broadly. So it looks like they have a clean sweep, and Trump will have more or less a free hand to implement whatever policies he wishes to implement. And I guess that's the problem thus far. Other than his opposition to Mexico, we're relatively uncertain as to what exactly it is he wants to do with the economy.
Jim, had the markets priced all of this in?
No, not at all. I think this was a huge upset, as Mark alluded to. Maybe the polls were close, but markets have moved higher in recent days, I think reflecting maybe a 20-25% chance of a Trump victory, and probably lower for a clean sweep. And so this, I think, has really taken the pollsters and the markets by surprise.
What else are the bond and gilt markets telling us at the moment?
Not very much. Yields are roughly where they've been over the last week, perhaps a little bit lower today. I would characterize it as a real tug of war. You have a little bit of risk-off environment kind of taking hold. And that is, as risk assets go down, like equities, bonds typically are a safe haven, that's helping them a little bit. But I think offsetting that is that we are really about to see one of the most expansionary fiscal policies, perhaps, that we've seen in a long time. You know, we've talked about the rotation of perhaps from monetary policy to fiscal policy as a way to kind of get growth going. And I think that's what you're seeing with the Trump strategy, right? You're talking about a very big tax cut. You're talking about spending increases. That is inflationary. And so you're offsetting some of those pulls lower on yields with, I think, inflationary pressures and that important rotation from monetary to fiscal policy. And that should drive yields higher over the medium term.
Mark, with Brexit, we saw that perhaps the true impact was seen in the currency markets rather than the equity markets. And they took a while to recover, if you like. Is that the case with the Trump win? Are we seeing something that we can't perhaps trust right now in the markets, and will it be reversed, or is it fairly accurate?
Well, it's such a globally significant currency, clearly the dollar, that I don't think is as straightforward as it was for sterling and Brexit. And I think there are many polls in many different directions on the dollar, but thus far it's been a bit weaker, but nothing of any significance. I think potentially it does have some consequences for sterling. Clearly sterling's been sat on the naughty step for the last 4 or 5 months. And I think there is a prospect for sterling to probably rally against the dollar from here, actually, as attention comes away from what's going on in the UK and we start to think about more international events. I think the other consequence is just this is a sort of second order of geopolitical risk kind of manifesting itself. We've seen a rejection of the establishment, both in Brexit and then with the Trump victory. And we've got elections coming to us in Europe next year. We've got the Italian referendum later on this year. We've got the Austrian presidential election. And then we've got big elections in France and Germany next year. And I think this has to up the risk, the kind of ongoing rejection of the establishment and what that means for the political consensus that we have today, what that might mean for markets. So I think that's something we're going to have to factor in as investors.
Because you wrote about the day after Brexit and the day after Trump, are you planning to produce another piece on any of those?
Yeah, I think we need to think very carefully about what we write about next, actually. That's quite prescient, absolutely.
Jim, sticking with currencies, are you keeping an eye on the emerging markets right now?
Yes, and so the dollar is down against a lot of currencies, such as the yen and the euro. It's up against the Mexican peso, for example, and most emerging market currencies. I think just reflecting the trade protectionism that people fear out of a Trump administration. It is one of the things that he can have a meaningful impact on from the executive office. And with Mexico having over 80% of its exports to the US, for example, they are kind of in prime position to be hurt. I think time will tell if the hardline rhetoric that we've heard is really followed through on. And I think that characterizes this whole campaign, which is there's a lot of things said. We now have to sort through what has been said and what he's likely to want to implement. And then thirdly, what can he implement with Congress? Those are three quite different things with respect to Donald Trump. And so he's not going to do things like just tear up NAFTA. He will try to renegotiate the terms. And so some of the worst case scenarios that you may have seen headlines on are probably not what transpires. So I think it's a wait and see attitude on currencies. So far the dollar hasn't moved, I think, so materially that it would have a big impact on global trade. Nonetheless, I think global trade would be expected to slow a bit just because of the heightened protectionism risk.
Talking about pre-election policies, with a Republican sweep, there's no gridlock now expected, I guess. Will we see policies enacted swiftly, do we think? Or?
Well, I he's so far away from being a traditional Republican. I still think there will be some checks and balances in the system that might moderate, if he wants to do extreme things, that might moderate that. And I think the Republican Party's got to kind of regroup, come back together and think about what it wants to be in terms of a government. So I still think those checks and balances are in place, but it is more likely that he can do more things given the way the political situation has kind of panned out.
And Mark, which sectors do you see being impacted the most? Obviously, healthcare is one of the key sectors we've talked about in the past.
Yes, clearly President Clinton would have been pretty anti the healthcare and the drugs sector, and we've seen certainly in the very short term that sector rally quite strongly this morning. One of the few sectors that was up in absolute terms when the rest of the market was down. More broadly, I think given the rhetoric that Trump has displayed against Wall Street, one has to think this is probably negative for the financials and the financial system more broadly. And then we've got infrastructure expenditure, potentially, defence spending, those sorts of things where he's made comments about wishing to spend more money than we've seen in the past. So those sectors are moving positively this morning, and that's probably going to be followed through in terms of what we see in terms of the outlook.
Jim, what are we thinking in terms of growth and inflation for the US now, and what about the Fed's interest rate decision in December?
I'd say it's hugely difficult to do point forecasts. We just don't have any detail around most of Trump's policies, and I think that's the key issue. We do know general direction, and that is that global trade should slow, but that probably impacts non-US countries more than the US. So I'd expect little impact on US growth, but inflation to be higher. So nominal growth could actually surprise a little bit on the upside, but that's through inflation. So we have to await more details. Like I said, I don't think we've elected a candidate in my memory where we've had such sparse details on what the policies would actually entail. Some of those policies, too, are so aggressive, like the tax cut, that you wonder if they'll really be as comprehensive as what was initially laid out. So I think on detail, we know the general direction of things, which isn't all bad. So uncertainty is there, but the growth outlook doesn't necessarily fall off dramatically because of this victory.
And before the election, we were expecting a reasonable probability of a Fed hike in December. Is that still on the table?
I think it's a matter of whether financial conditions tighten between now and the Fed meeting. They very much want to tighten. And let's remember, their focus has been on inflation. And if anything, the outlook for inflation has gotten worse. And I think inflation expectations probably move higher from here as well. So as long as you don't see a serious decline in equity markets and financial conditions tighten, I still think the odds are that they will move. The odds have clearly, though, gone down according to what the markets are pricing in. You've seen the probabilities fall below 50%. And I think that's probably about right until we see a little bit more of the market behavior in coming days.
Mark, with Trump winning, the rollback of globalization is on the table now, isn't it? And possible trade tariffs. And how worried should we be about these headwinds?
Well, globalization has been very positive for the global economy in terms of GDP growth and what it's meant for efficiencies. It's brought down inflation. It's driven the development of the emerging markets, which has been a positive for that region, and that in turn has been positive for the global economy. So it's a negative event more broadly. It may well be a more positive outcome for the US in terms of jobs and what it means for how the US feels about itself, but unequivocally it's a bad event for the globe, and I think we have to be pessimistic about what it might mean for GDP growth going forward.
Jim, what other headwinds are you seeing? Because we've got, we know about the global banking system. China is still there as an issue, and we've already mentioned lots of political headwinds around the world, particularly in Europe. How seriously are you taking these?
Well, I think very seriously, given the kind of cascading effect that we've seen with the reversal of globalization. And for us, the risk would be that it spreads to Europe. We have an important Italian referendum in a few weeks in December, and then a full slate of elections in Europe next year. We have a president who will have the ability to do things on trade protectionism, some of those with the approval of Congress, but quite a few without the approval of Congress. And so there's a lot of headwinds, and that's, by the way, accompanying what was already looking to be a rollover in global trade, weak capex and things like that. So the policy uncertainty, as well as just the uncertainty around markets now, probably does provide an additional headwind to global growth.
We've got a relatively robust financial system in the United States. The same is not true in Europe. The European banking system remains, fragile in terms of its capital. And were we to see a further destabilization of the Eurozone brought about by, populist parties, looking to take a significant member of the Eurozone out of the single currency, that would place a lot of pressure on the European financial system and would be a pretty significant event for the global economy and global markets. So I think that's something we have to think about as we look at these elections that we've got coming up in Europe next year. This has the potential to be quite significant.
And China in particular, when will investors start looking at that again? Because at the start of this year, it was the big deal and everyone was fretting and it sort of went away but didn't really go away. And will we turn our attentions to that soon?
Yeah, China's interesting. It looked soft in the beginning of the year. It's rebounded, but it's a debt-fueled rebound, like so many rebounds are today, and you see evidence of bubbles in the housing market, things like that. So there was a lot of fear around China before a Trump victory. He has threatened in the past to label them as a currency manipulator. Whether he does that, you'll notice he's been quiet on some of those threats now for a while. Whether he does that or tries to impose tariffs, I think remains to be seen. But it's a fragile enough situation. We are somewhat constructive on the growth outlook. It seems to have stabilized. But there's a number of things that exogenous, such as these exogenous factors, that could kind of poke some holes in the China story.
So now the election's behind us, as global investors, where are you looking for opportunities right now?
Very carefully, I think. So I guess Brexit's taught us that the first reaction by the market is probably the wrong one. I think we need to think about what we do. But clearly, inflation is a potential significant turning point. What that means for interest rates, what it means for bond yields, and it's been the bond market and the relative strength of core bond markets that have driven risk appetite more broadly. So if that starts to change, and what that might mean in terms of the underlying sectors, I think we need to kind of wade through that to make sure that we're doing the right thing for our customers.
And does Trump's win actually open up opportunities that weren't there before he won?
Well, like all volatility, it opens up many opportunities. I think what is more confusing today than perhaps it has been is just the general direction of beta. So do risk markets rally or sell off? Do rates rally or sell off? I think those are harder questions to answer, given that a lot of these markets are quite fully priced and the direction is so dependent upon policy, and we don't know what that will be. The volatility, though, creates the opportunities, I think, to really look at good companies and the emerging markets that perhaps get tarnished just by being emerging markets, but actually can hold up quite well. So a lot of alpha opportunities, I think, is what we'll be looking for.
And this is where active management can really add value, isn't it?
Yes.
Okay, Mark and Jim, thanks very much.